wonder if Steve Forbes agrees with that, Steve, the Fed's between a rock and a hard place on this. It wants to get tough on inflation, but in this environment with, all this debt, it can't. What do you think?
Well, the problem is the Federal Reserve thinks you fight inflation by depressing the economy instead of stabilizing the dollar, which is what was done in the mid-1980s to the mid-1990s, and it worked. So we're in for a recession. The economy is stalled now. You saw the final sales report in the third quarter GDP report, virtually flat. So we're going for a stalled economy and next year a shrinking economy. So the Federal Reserve should stop trying to depress the economy and let interest rates find their own level in the marketplace. We've had over 12 years of suppressing interest rates. That's why government debt went up so sharply, because it was free money. The debt went up, but the interest costs did not. So where the Fed should just back off on the interest rates, stabilize the dollar, and hope Biden administration stops waging war against energy and other things.
The argument for raising rates is that we still got inflation. Obviously, after all the hikes we've seen, I guess by the end of tomorrow, Steve, we'll be north of 4%. In that neck of the woods, they would have quadrupled in all of that time. They could get to 5%, so quintupled in less than a year, and no demonstrable signs that pricing pressures have eased. Do you think the Fed is risking overdoing it, that by the time they realize the magnitude of the impact, it'll be too late?
That is the danger. They are in danger of overdoing it, and you see signs of it already. Already the Treasury market is starting to show a little bit of a hiccup, which is a real shock. You see the money supply, what economists call M2, which during COVID was going up 40% a year, is now flat and has been flat since December. You look at the gold price, another indicator, canary in the mine, that has been going down. So by the time the Fed realizes that it's stalled the economy, it's going to be too late. And that's why they got to realize a lot of these numbers are backward-looking numbers, like the CPI, Consumer Price Index, and realize the economy is slowing and contracting now. And like a big freighter, they've got to realize that by the time they make changes, the economy is going to be in bad shape.
Let me ask you about what the markets might be telling us or telegraphing about the election next week, that Republicans, at a minimum, take the House, could take the Senate. So it's a hypothetical, I grant you, Steve, but let's say Republicans take both. How will the markets respond to that?
Well, the old phrase, the markets buy on rumor and then sell on the news. We had a great October, I think, in large part anticipation that the Republicans, who in September looked like they're in trouble in those congressional races and Senate races, are now turning things around. It's going the other way. So the markets, I think, will probably not have too much reaction unless there's a real red wave where you get 40 or 50 seats in the House, 3 or 4 or 5 seats in the Senate. But I think what the markets are going to be looking for now is what are the Republicans going to exactly do in January when they take the reins of power on Capitol Hill. And one of the things I think they're looking forward to is putting in legislation forcing the federal government to allow leasing, allow pipelines, and get more oil and gas production in this country, because there is a shortage around the world. It's going to be a very bad thing if we don't correct that soon.
Steve Forbes, thank you. Good seeing you again, Steve.